Hello everyone, Namaste. This is CA Pravesh. In this video, we are going to discuss about balance of payments. So let's start. Balance of payment. As the name suggests, there can be various payments made by a particular country to outside world for some transactions. Similarly, some payments can be made to that particular country by outside world for similar or other nature of transactions. And if all these payments are recorded and an account is created for it, then the balance of that account would be called balance of payment. So, by the definition given here, balance of payment would be a statement that provides systematic records of all the economic transactions made between residents of a country with the rest of the world for a particular period of time. Generally, balance of payment is calculated on annual basis. The balance of payment, which is a statement, consists of two accounts. Let's understand three components of the current accounts. Trading of goods, which is also known as trading of visible items. We can say tangible items. Trading of services, or we can say invisible items, and net transfer or unilateral transfer. There are three components of the current account or current nature. Trading of goods, which is import and export, which leads to the balance of trade, which is a very popular word, balance of trade. So actually, balance of trade is a subcomponent of balance of payment. It is import and export. Import is denoted by M and export is denoted by X. The difference between X and M is balance of trade. Now the question is, when it is considered that the country is doing well in the context of balance of trade? When it is importing less than its export. So when the country has more export, it is doing well. When the country has more import as compared to the export, it is not doing well. For example, China, it exports more than its import. And the countries like Nepal and Bhutan, they import more than their export. So in China, there is surplus balance of trade. And in Nepal and Bhutan, there is deficit in balance of trade. Okay. So let's move to the next one. Trading of services. So there are various nature payments which are made for different nature of transactions. Like if resident in India is holding some assets outside India, then he is going to get some return from that asset which is holding outside India. Like if a person has a residential house in UK and he earns rental income from there, he will get that rental income from UK to India. This is income from, you can say, a service. Some other payments like royalty, franchisee fees, okay, trademark fees. So this kind of payments can be made by foreigner to India or by Indians to, or Indian residents to outside India. So the difference between the import or export of service would also lead to surplus or deficit of balance of payment. So the third one is net transfer or unilateral transfer, or you can also say it is a one-sided transfer. For example, donation or gifts or grants. When it is received by India, it is inflow. When it is given to some other country by India, it is outflow for the India. Okay. Similarly, let's go to the components of the capital account. It is very necessary to understand that the transaction of capital goods will also fall under current account because that is also trading. Okay. So we will not say that the import and export of capital goods will be covered under capital account. It is not like that. It is not like your ordinary accounting principles or accounting standards. Okay. if we are going to export and import certain goods, either be it small goods or very large plant and machinery, that will be covered under current account. So after understanding that part, we can easily understand the components of the capital account. Capital account, I have divided the components of the capital account into three parts. One is borrowing, another is investment, and another is other. Borrowing, you already know it, loans. When we take loan, there is inflow. When we provide loan, there is outflow. Okay. So loan lena, inflow, loan dena, outflow. Okay. So this is going to hit the balance of payment, right? Similarly, foreign investment. India can also do investment in some other country, and for that country it will be foreign investment, right? There are two different types of foreign investment. One kind of investors will do investment in securities only, like purchasing shares. We are not interested in running the business. Okay, so this kind of investors are known as foreign portfolio investors or foreign institutional investors. They do not have any concern on how to run the business. They are only concerned about the shares and the benefit they can take from that shares. But talking about the foreign direct investments, these investors will invest in the infrastructure. These investors will try to control the business, the nature of its transactions. Okay, but in both the cases, if foreign direct investment comes in India, it is inflow of the payments. And if the India makes the investment to the outside world, then that will be outflow of the payments. So after understanding this part, we can go to the third one. It contains other various nature of transactions like NRI deposit. Non-resident Indians, if they deposit their saving in Indian banks, then that is also considered as capital nature of transaction. It is not similar to remittances. Remittance will be covered under revenue account. It is very much necessary to understand that. It is current nature of transactions if it is remittance. But if it is just a deposit by the foreigner or non-resident Indian in Indian banks, then that would be considered as capital nature of transactions. Similarly, banking capital. It is just like NRI deposits, but it is made by some financial institutions or banks. Okay, if our bank or Indian bank invest in certain securities of some other banks which are outside India, then that would be outflow. And if some other banks invest in certain securities like bonds issued by RBI or Government of India, then that would be the inflow of the payments. Similarly, there is another nature of transaction called official reserve transaction. Official reserve transaction is just the adjustment to the balance of payment account made by the RBI while making the or preparing the balance of payment statement. Okay. So in nutshell, the balance of payment is the difference between the inflow of the money to the country and outflow of the money from the country. Okay. We have understood all the factors that are accounted while preparing the statement for the balance of payment. I have prepared a small statement showing the nature of the difference. Okay, so this is the statement of balance of payment. It is just like a ledger. It has debit side, credit side. All the inflows are depicted on the credit side, and all the outflows are shown on the debit side. So if the outflow and inflow are equal, then it is balance, just like a ledger. But if outflow is more than the inflow, this is not good, right? This is deficit. And if the outflow is less than inflow, that means inflow is more than outflow, then this is surplus situation. Okay, so it's very easy, simple concept. We don't need to get confused about the wordings that are used here. This is simply money comes, money goes, and the difference for a country is balance of payment. I hope you've liked this video, and if you want me to do some more videos on related topics, do let me know in the comment section below. Thank you.